Yeah. So again, moved out here in 2019, kind of transitioned in 2017 from the commercial banking to residential brokerage in the Chicagoland area. Kind of started as friends and family, and then migrated to Colorado in full-time business.
Nice.
Alex, Jim, Kyle, and soon to be Ethan are our business partners. Alex and I have worked closely together since about 2019, late 2019. We were at a small boutique brokerage which merged with Compass, and then now we're at EXP Realty. So everybody on the call right now is at EXP. We've had a relationship with Darren and Shalea since being introduced by Louis Galt in what was it, Alex? Maybe mid 2020. And it's been a great relationship. We've gotten a lot of deals done, and hopefully more to come. So today we kind of wanted to get on here and talk a little bit about current market conditions. The way that we kind of work this Friday call is we kind of have a rotating quote unquote host. I'd like to keep it conversational, but the idea is that we have different topics and can kind of, the idea is for this thing to eventually grow and grow and grow and just bring different perspectives to the table from all aspects of business, whether it's current market conditions, open houses, lending, for example. So, as this grows, we'll have guest speakers on, and we'll obviously look to Fairway for some of those as well. So that's kind of the 30,000 foot view of myself as well as the group and what we're trying to do here. So thanks for jumping on. And with that, we'll kind of get started. So obviously, from the perspective of residential real estate, the maybe not recent anymore with as fast as things are moving, but the relatively near-term uptick in interest rates have kind of put a little bit of a spin on the market conditions, right? So maybe last quarter, whereas there were many offers on homes, both good and bad. Now, at least from my view, which is why I kind of want to get everybody else's perspective, I feel like the supply and demand is flattening out a little bit. I do think that it's probably more so demand than supply, because I feel like supply is still relatively short. There is some good inventory coming on, at least where we're at, but if you're not coming on the market right now in really good condition, you're sitting. Or if you're coming in thinking that you're going to get ultra high price per square foot, compared to when interest rates were in the 2s and 3s, you may not be fetching those, and we're seeing price reductions. So that's kind of my perspective. I've got a property under contract right now in Littleton, and we're 19 grand under ask. And 3 months ago, you never would have seen that. There were no other offers. The home was on the market 11 days, and we got a discount on it. So I think from the perspective of working with buyers, it's great. I think now is a great time to kind of transition back a little bit if you've kind of gotten away and started looking at a lot of listings. I think listings are still really good, and Alex can speak to this. He's got a really nice listing coming on, and it's getting offers first weekend. So as long as they're in good condition, good pictures, getting people in, I think you're still seeing first weekend movement. But if you're kind of maybe not doing as well as you could have on the picture front or the marketing front or even the conditional front of the home, it's likely that it could sit a little longer if you're really trying to fetch that sales premium. So that's kind of that's my point of view. I would look to Kyle is in Manhattan, Kansas. He's got a little different perspective probably, and knows his market well. And Alex is doing deals kind of all over the place as well. So I would say from that perspective, it is nice because I don't think you have to give away the house anymore. I don't know what you're seeing there from that perspective, but you can get conventional financing done. You can get FHA done right now. Whereas several months ago, those things weren't even in the mix. You know what I mean? I have heard of other members of our team even getting some down payment assistance programs done again. So I would kind of just look to everybody else and see if that's kind of what everybody else is seeing in the market. I'd like to hear maybe a little bit of Kyle, Alex, Jim, and Ethan's perspective on what your thoughts are, and then Theron from maybe a lending perspective, what you're seeing as well.
Sure. I look at charts a lot, and I can show you what I'm seeing on charts.
Yeah, mine as well, dude.
I'll because I just, I've been watching this for a long time, and so here's like the S&P 500, and of course, this isn't directly related to real estate or anything else, but there's just kind of some interesting things that have been happening. So like I've got these like major trend lines drawn. So like this is all the way back 2000, and like I have it drawn like all the way back to the 60s. It's like this is where we kind of topped out on that .com bubble, and then because I've been watching this, I think I drew this like summer of last year, watching this trend line, watch it broke like December, January. And so that's kind of what's kind of started, really alerting me, because it is in this rising wedge pattern, which is like very bearish pattern, which it looks really bullish and you get a lot of FOMO. And so like, we just kept on going up and up and up. And and we broke that, and we've been on a consistent downtrend. And you see this line right here, and I have this line drawn all the way back to when I was born, back in '87. It's been a very good line. It's just so many points. We broke it.
That's the bottom yellow line, right?
Yeah, the bottom yellow line.
Yep.
So we broke it in 2008. We came all the way down to this red trend line. So like these two red ones are kind of like our range. So like you kind of look at it from a macro perspective, like, we've just like, it's just bare, look at it, it's like, oh, well, that's just a tiny dip, but we're down, like a lot of people's portfolios are down like 50% like in this year. We kind of popped up above it, summer and fall of 2020, and we kind of went on that little massive bull run. And anyways, we broke that. So it actually just like I had this drawn here for since we were about here, and it like kind of perfectly touched that point and retraced, and so those lines are still holding consistent. Now we just closed a month yesterday, and it's the first time, of course it's too early to tell, but it's the first time that we've closed below this line without having with a massive, because the last time we closed below this line was September of 2008, and we retraced all the way down to here, and that was a very verified recession. But around here, like, oh, maybe we might get a bounce, like we have a moving average here, and it just broke right through all of those. So basically, I would say that July is going to be a very telling month. And so I've been watching this, and this is December and stuff. It was looking in November, it was looking like we were topping out in the markets, and we did, verified, came down here, broke this another little trend line I have. So, and then it was like 6 months, which we typically see. It was about 6 months later, we started to see it in the housing markets. So the Fed is trying, they've been calling it a soft landing, and now they're saying that we're not sure if we can have a soft landing. And of course, their big major tool is to use interest rates to control demand, because there's a lot of free money flowing. So, really got pumped in the housing markets. So it's kind of, and I have a question I'll ask all of you is, so because real estate, typically follows this, and, we have seen like 6 months of decline and stuff. And now we're, just in the past couple months, we finally get caught up to this. So people have less money to put in, but then there's other things. So people are pulling money out, and they might be invested for years, and now, hey, this is a good time to pull out. And maybe real estate is real estate a safety haven, or are we going to kind of follow what all the other stocks, crypto, and all the other equity markets are doing?
This is the age-old question, right? I don't think when I was a banker, you guys are going to hear this till the day you die, because it's the age-old adage, but I don't have a crystal ball on what's happening in the future from either an interest rate or a market perspective. But I would say this, when you kind of look at that trend line, I don't think that there's any doubt that as of 6/30, when we get the GDP numbers, we're going to be in a technical recession, right? 2 quarters of negative GDP growth, we're going to be in a recession. But what I do think is there's still a lack of supply, total supply in the housing market. So even if we're in a recession, I don't think it's going to cut as deep as like the 8, 9, 10, 11. And we're not in an inverted yield curve. So, if you end up hitting inverted yield curves, they've predicted the last 7 recessions, and we're not in that right now, even though we are in a technical recession, probably at 630. So I think that this is going to be a little bit more shallow. I do think that what the Fed's doing with interest rates is probably, in my eyes, it's slowing growth, which I think is a good thing, because frankly, the growth we had in the real estate market is not sustainable, or wasn't sustainable. So kind of the way that I see this, and this is just my perspective. I think that we're probably going to see, even from now, we're probably going to see a little bit of uptick in interest rates. I think that they're going to try and combat inflation first and foremost. I think it may have a little bit of effect in the housing market from a transactional perspective, but I don't think it's going to have long-term effect on value. I think basically what we're going to see is, instead of a growth like this, we're going to see a more sustained level to flat growth for a little bit. And then I think that rates, midterm, call it 1 to 3 years from now, after these short-term tick ups, are going to come back down and probably stabilize at something more long-term sustainable in like the 4.5 to 5.5% range. Like, I don't know if in any of our lifetimes we're ever going to see like below 3 long-term rates again. You know what I mean? You may have a different perspective, Theron, but I just can't see that. I mean, when I started lending money, we were on a prime rate, which was like what you're lending to tier 1 corporations at, floating 8.25% to 9.25% interest. And, in some instances we're lending +1. So we're giving multi-million-dollar line of credits floating at 9.25% to 10.25% interest, and from like 07 until 6 months ago, the prime rate was fixed at 3.25%, if not below. So I think that there's been a long-term need to rise interest rates. I do think that they did it a little bit sharply, but that's okay. And I think that from a seller's perspective in this real estate market, like, I think we need to educate our sellers that it's just not going to be the feeding frenzy it was. Not to say you're not going to catch perhaps the best value of their lives, because you still can. But I just don't know that it's going to be, I think the days of 20, 30, 40 offers may be in the rearview mirror. That's my perspective for what it's worth. I'd kind of be curious to hear your perspective, Theron.
Yeah, so I do agree with the interest rates not going down that low probably ever again, unless we have a situation where the Fed's putting $90 billion into bonds, right? A month, like they did for 2 years. I mean, that's the only reason we were in that range. One thing I do like to bring up, just 4 years ago, these rates were in this same ballpark. It didn't affect people as much because your core costs, fuel, food, those types of things weren't that high. So it's kind of a perfect storm of all the things at once. I do think it's been a good thing just to slow stuff down. And like you're seeing, because we are seeing bond program buyers be able to buy houses now with some concessions from sellers. Prices have stabilized, which is what the Fed said they were going to do last fall. They just took forever to implement it because I think they thought they could outrun it, and they could let it slide a little bit. And then, the war in Ukraine did start changing some things, so that really pushed their timeline, and they missed the cut for sure, because we all knew it was coming. They just were trying to, in my opinion, negotiate through that without having to mess with stuff too much, and they did miss the boat for sure. I can give you a little bit of background for me. So I've been in finance forever. My degree is finance. I used to work in trust departments and manage investments in 401ks, then sold cars and car finance, things like that. Was in mortgage before, went to cars because it paid more through 08. Then that happened, and went back to banking and different things like that, and then back to mortgage here almost 5 years ago, I guess. So kind of what we're seeing. So Fairway, I don't know if Shalia can get you or has got you this information, but we pay a guy, Dave Stevens, Fairway pays a guy named Dave Stevens a ton of money to consult for us. He also is part of Biden's economic team that they brought in to look at the mortgage market. He's been in charge of Fannie, Freddie, HUD, those types of things. I mean, he's a big name in the mortgage industry. So he does updates for us every month or so, and she can kind of get you that information because it's good information. But the thing that we're seeing, we do think it's going to slow down a little bit, but it's kind of and kind of why we think it's slowing down is the inflation part. For the most part, really, the demand is going to be high for years. We have thousands of millennials turning 31 to 34 every day, and that's going to continue for years. So we have a 4 million-ish range of buyers, less than 1 million houses. So we're not an 08 at all, where we had 5 million houses and 900,000 buyers and the same 10 people buying whole subdivisions in places like Phoenix and Vegas. It's not that situation anymore. We don't do stated lending, stated income lending, things like that. So, with debt to income ratios and stuff like that, they've really squashed that. Then you also have the people, older people aren't selling their homes. They're keeping those and buying other homes. You have people that are, because of Airbnb, like Darren, I think just bought his 4th house for an Airbnb yesterday. We're building a house and we were going to sell ours. I'm not going to anymore. I'm going to keep my house and we're going to short-term rental it too. So that's all those cycles have kind of killed the market because it had been really cyclical. The grandparents sell their house, the family coming up buys the house, and so forth. And now that's all out of whack. Yeah. And then your millennials' income is high in that 31 to 34 age range where they're turning to first-time home buyers. It's also the highest age for first-time home buyers ever. So they're waiting longer, but in that range, it's typically 2 people, maybe not necessarily a couple. A lot of times it's friends anymore buying a home together, but they each make over 100,000 or right at $100,000, which is not, I'll be 47 in a couple of months. That's not what we made out of college. That's not what we made at 30. You didn't make 200,000 as a couple together. And that's just the numbers right now. So I think that our area is doing great because we're finally getting houses on the market. We finally have inventory. Things are finally catching up. So it's been a blessing for us, just for, like you said, it's not overpriced situations. It's not all cash buyers. We're getting some people with loans or actually getting the deals finally, things like that.
Yep.
So it's been good here. And I think it's going to be good for your area too, where it was so inflated. You just priced so many people out of the market that I think some people, all those people that couldn't now, I'm getting people back that just thought they couldn't before. So, and we had last 2 months have been huge months. June will be my biggest month ever in mortgage. So without refinances. So, the people are trying to sell, they want to hit the top of the market. Now they can get a discount and they don't have to go over with their money on the home they want to buy. So it's a lot of people are coming out of the woods, I think, and jumping in the market.
I'm one of those people. Oh,
yeah.
I just have a question kind of for the group. So go ahead. And you're down in Grand Junction, right, Darren?
Yeah.
Or I should say over west, but yeah.
West in Colorado. Yeah, no, we're born and raised. I'm 4th generation out here. We've been here for a long time.
Nice. So I guess my question is, like, what are your thoughts? Because out here right now, the rental market's also going gangbusters, right?
Yeah.
And I think part of that is probably predicated on the fact that there were so many institutional buyers when the money was cheap. Like I personally have a friend at Jones Lang LaSalle in Chicago, and they set up $1 billion fund to buy a single family home. So I think that there's a lot of that in the market, which is also, aiding the supply shortage. At some point in time, I think that, I don't know, either they're going to sell these things as packages, or they're just going to hold them for cash flow, or they're going to like one-off get rid of them, right? I think one-off getting rid of them is probably not the way they're going to go, just because they're going to own so many homes. But that could, I don't know. I mean, from my perspective, as the values rise, they could potentially start dumping some of these at higher market values, right? Like, I just don't know, but I know that it's definitely affecting from an economic perspective, the overall residential housing market for sure.
Yeah, for sure. The cycle's all out of whack. It's not a cyclical thing in real estate anymore, especially when you get giant. I mean, how many investors, big investors like that, hedge funds and stuff, have billions of dollars that they're spending on real estate? It's a bunch. So that's throwing it out of the market too. And for James, with as far as your charting and stuff like that, one of the best investments in a recession is real estate, because when everything comes out, then real estate spikes again. So everybody buys. So I think you're right. I think the investors will stay into it. I don't know when they jump out, but they're still buying here on the western side. And in the mountain towns, you still can't touch a house for anything. If you're not over, you're not buying it. And in some cases, it's hundreds of thousands over for an inflated priced home still to buy it. So yeah, I just think it's going to continue. And they know the same thing that we know. They know there's millions of first-time home buyers,
sure,
with good income. So I think that they'll continue to buy, especially now, because again, the buy the dip or whatever. I think this is kind of our dip, and it's a chance before that storm comes back, because we know some of this will hedge out and they'll get some of it figured out.
Well, it goes back to the same thing too. I mean, the market's always good. It's just who's it good for.
Right. Exactly.
You know? So, I mean, hell, I just picked up a house because I buy and flip houses in my town. We literally just picked a house up for 157,000 here. And currently it's a 3-bed, 2-bath with an unfinished basement. I got an appraisal after repair value for 325.
Cool.
That's huge.
Yeah, I mean, so it's always good. And shit, I could just do the top floor and probably sell it for 250, 260. So
that's the thing we're seeing over here too. So my dad's been a builder my whole life, commercial and residential, done quite a few subdivisions and things like that. And the investment in commercial over here, there's like 10 or 11 new restaurants going in, Costco's, things like that. We just got a Dillard's and some stuff like that, which is big for Junction. That's big
for sure.
All that at once is a big deal. And typically those companies spend a lot of money on research before they do any of that. So I think that as far as just the numbers that you see on our side of the hill and your guys' side of how many families are still coming in from other places, and Denver here, we're really cheap compared to a lot of the places people are coming from. So they're still coming in, but conversely versus LA and a lot of those places, Denver's still pretty cheap for some of the properties. So it's relative to a lot of that too. We have a lot of people coming from back east, northeast, and California, Washington, Oregon sides, and we're cheap compared to those places. So it's still a good deal here.
Yeah, we moved from Chicago. The guys on my team have heard this, but we moved from Chicago and we sold our house in outside of Chicago for $500,000, which isn't crazy by the town we were in standards. But our real estate tax were 4% of value. So our real estate tax were $20,000 annually.
Yeah.
So, we moved out here and our home's not quite double the value, but our taxes are like under half of it. So we have double the mortgage and my monthly is less than it was in Illinois, which is crazy. So like tons of people are coming here from Illinois because of the tax situation, both real estate and income tax. We had a 5% state income tax in addition to your federal income taxes. So like, and our purchase sales tax in Chicago was like 9.5%. So like, you're just getting hammered in every angle. So tons of people are coming out here from Illinois. I live in Evergreen and there's 20,000 people in Evergreen. I run into somebody like
we've done a few from Missouri recently, same kind of thing. This guy was a pharmacist and he was selling his place that they'd had forever. and the tax bill was over $1,000 a month. The house was only valued at $150,000, and it was $1,000 a month. He couldn't have rented it for what his taxes were.
Yes.
And he thought it was crazy buying a $300,000 house here, $350, and his taxes here are $1,200 a year.
Yeah. Yeah. No, I think that's you know, obviously it's all relative to where you're coming from, but people coming from, I don't know, Ethan, Texas, you know, you guys have pretty high real estate tax in Texas, right? But you don't have state income tax. Right?
Yeah. So down here, I mean, like you said, you were talking about cheap money. We have apartments popping up on every corner, you know,
Really?
down here in Grand Prairie. We're about 35 to 45 minutes out of Dallas, and there's apartments popping up everywhere. And, you know, Theron, you commented on, you know, the age for first-time home buyers. I'm a younger guy, so I'm in contact with a lot of younger people. And, you know, like you said, they're not looking to buy until they're either out of college or out of graduate school,
Right.
just because the median price is just too high. And I think it's, you know, priced a lot of first-time home buyers out. And I think we'll see that age rise. But,
Yeah.
you know, the rental market, it's like you said, it's just going up. We got people paying, you know, again, going back to, I got friends who are paying $1,400 a month, you know, just for 1 bedroom, 1 bathroom. And, you know, that's going to affect their ability to, you know, save and get into a new home. And, you know, that's on top of things like, you know, paying for their school loans and stuff like that. So I think, again, it's really just going to affect, you know, when people are going to be able to get into a home in the first place.
Yeah.
One thing about the rents that I think you're going to see now that the refi thing's kind of over, you're going to start seeing, and it always happens depending on where it is, but you're going to see the big mortgage companies start doing their push, right? With their advertising pushes. So this advertising push, I believe you'll see, because we're already kind of seeing some of it, but how much are you paying in rent? Are you paying $1,800, $2,000, $2,100? That's, you know, that's a $300,000 house at interest rates right now here anyways with taxes and stuff. So do you want to pay rent at that amount, or do you want to own the home? And now we can get bond buyers buying again. So they only have to have $1,000 or Chaffa, or depending on where they're coming from. So I think you'll see that big advertising push start. And then usually the advertising starts, and then we start seeing the people 30, 60 days after you start seeing all the ads. And I'm guessing that's the next way it's going, because I'm hearing it in different conversations from bigger lenders. So
Right there, and I've got a question for you. I
house.
don't know if you know the answer to this or not, but are FHA loans assumable?
So it depends on when they did them, because I believe some of the older ones were not currently. I know VA loans still are.
Yeah.
But I believe it depends on when you did it, because I know currently the newer ones are not.
So let's say a VA loan's assumable. If somebody's in a VA loan, does the person that's buying have to be a veteran as well to assume that VA loan?
Yes.
Yeah. That could be a good play to drum up some business from a sales perspective. Like, hey, rates are up. If we work on like a VA to VA type situation, do an assumable loan, that could be a benefit for buyers.
I only know some of that with the VA because we just had one pop up, and that's how the realtor was presenting it, because they're at 3.25.
Exactly.
And they're pushing it.
How they, in that scenario, how did they get over the equity play?
So you have to come with the money somehow. Yeah. So if you can have a second or something like that and still make the ratios work. But yeah, you selling your home, you have to come with the money. So that's, you know, that is part of the problem. That turns into that makes it a convoluted thing. But
I think it's going to become a bigger and bigger deal as the market. I mean, obviously, like I have a veteran of mine. I call him mine, a client. I have a veteran that he literally was at, what's that?
Right.
He's in your basement.
Yeah, right.
You can come out now.
But no, he came to me yesterday. They were literally sitting in my office yesterday. They said that he wanted to assume that loan to his buddy, his friend. And I was like, well, you can do that, but you've got $60,000 in equity that you can't touch for however long, you know?
Yeah.
Right.
And so what we ended up working out is that they're going to do, apparently they're really good friends. I don't know that I'd give my best friend this deal, but they are, he's giving him a $60,000 zero interest loan for however long the guy takes to
So
pay
is
him
he gonna
back.
take a second on the property and just have like a silent second that's
He's
no
not even
interest?
going to do that. He's just
Oh.
going to trust that the guy's going to pay him back over time.
Yikes.
Yeah.
There's part of the reason I asked, get this, there's a property in my town that's been sitting on the market. It's a single unit, but it's got 2 outbuildings that I think could be converted to Airbnb. So you could have 3 total units. And right now it's got 2.875 fixed rate 40-year FHA money on it.
Yeah. Huge.
And if I could assume that, like, it's a no-brainer.
If it's a 40-year, it's an older one, so it might be assumable.
Yeah. Interesting. I think that like these are all things that, because we're like in this market shift, are all going to come to light, because you kind of gotta. I think creativity is going to win the day. I mean, they always say keep it simple, stupid, but if you can bring creative ideas to the table, I think you're gonna win a lot more business than a lot of other people right now.
And you guys are probably start seeing it already, but ARMs, that's all we're hearing about, and 2-1
Yeah.
buy downs and everything like that. That's all.
Yeah, the 2-1
that's
buy
coming
down.
back.
We're hearing about the 2-1 buy down on the list side. You know, I was talking to Darren about that the other day. You know, prepaying the 2 years of interest.
Yeah.
I like that idea a lot, because then it buys the buyer some time to see what's going to happen with rates. If they go up above, you know, the current market rate, then you're still in the money for perpetuity. And if they
Yeah.
drop down, you could refi.
Absolutely. And that's what, you know, we like that, because then we know we have a refi and whenever
For
the
sure.
rates do a thing, right? So it's
For
it's
sure.
good for everybody for sure. But I like those, especially with so much equity. It doesn't sting so bad when there's that much equity in all these
Yep.
homes. So,
Yep, exactly.
Hey, Theron?
Yeah, Theron, you know Nicole Ruth, right?
yeah.
Yeah, so one of our partners does a lot of business with Nicole, and he actually does a lot of listings in like the Denver Littleton area, and he's working with Nicole on some of those 2-1s.
Yeah, she's a monster. She crushes it.
Yeah. And
It's funny, I have a buddy from here. She used to be in their accounting department at his agency and used to do like 1 or 2 loans a month. And then she kind of left it her own thing. I was like, well, she does like 60 to 100 a month now. So she's doing pretty good.
60 to 100 loans a month?
Yeah.
Holy shit.
She's the biggest in the state
Yeah.
of lenders for sure. She's a monster. She's great too.
Yeah, I've not personally met her. Have you met her, Jim?
Yeah, she was at our like happy hour in June.
Yeah, that's right.
Or sorry, May. I know that she's like doing a like buyout program for people who are like renting. And what kind of programs are you doing with the shifting market, Theron, on there at Fairway?
So right now, she has some different investing things that she can do, different programs and stuff with different lenders if she brokers them out, which we can do. Not a lot yet. They're really pushing the 2-1 buy down, and the ARMs is kind of where Fairway's going right now. We can do some different things.
Yeah, Theron, just by way of background, and Jim, the way that program works is whatever the lease break fee is, Nicole and Jeremy are splitting it 50-50.
Yeah, so that's what I was going to say. We can do some things there with changing the point, so we can actually go make the interest rate be above par to get some money to help cover that on our side from the lender, or different things. So there's some different things we can come up with some money. That's kind of up to the lender and what they want to do, though. That's not necessarily a Fairway thing.
Yeah. I like it. I like the idea. I mean, you know, Jeremy Kane's one of the guys on our team. He's out here in Colorado and he crushed it too. He does like 60 transactions a year. And his goal was to get 20 people out of rentals this year. So him and Nicole are pushing that program pretty hard. I know that they've already done a couple deals, I believe, on that. But I like the idea. It's again, it's one of those things where, you know, they're getting creative and they're making a market, and that market is getting people out of rentals and getting people off the schneid thinking that they can't get out of a rental into a home, you know? So
Right.
it is a lot of explanation and knowledge base on Jeremy's part, but he's good at that, you know? So
Well, and it's like Kyle said, the market's always good for the people that do the right thing. So
Yep.
And this is good for us too. We had like 1,200 realtors in Grand Junction, and typically we have 150 to 200 listings a month in this market. So they're dumping those, or they're putting their licenses on hold. We had way more lenders than we have loans for that many homes, so they're going away. I mean, the market will clean itself out. It always does. So
yeah.
it's a good thing.
Just for my
us.
information and the guys on here, how does your business relate to Darren's? Do you guys work together? Or are you like your own production? You have your own P&L, or how's that work?
So the branch is his, so P&L's him. I'm just a loan officer. I do my own thing.
Okay.
So yeah, we work. He's the branch manager, but we're basically self-employed.
So if I've been doing business with Darren, does that help you in any way, or is that just completely separate?
Just completely separate.
Okay.
It does help. Like I've talked to James a couple of times. We worked on some different things, and we had some different people we were looking at, and he does. If he's going to be busier on vacation, he'll definitely give us some of those different loans he has going on. But other than that, we're totally all separate.
Okay. Good to know.
Like Nicole does it differently. All of the LOs under her are junior production partners to her production partners. So all their business goes directly to her, but then she pays for processing, underwriting, and all that in-house so they can get all that handled. And then they learn a lot of neat stuff through her. She's big on investment. So, but Darren, we're all separate. I think we have 7 or 8 loan officers under Darren.
So does that mean like her LOs are like salary and bonus versus completely production based?
So they're probably on a commission, but it's a lower commission base because they're under her and she pays for all those things for them. So
Gotcha.
yeah, it's a little different business model.
Yeah.
They're more employees than how it is for us here.
Sure. Nice. Unrelated, I stayed at one of Darren's Airbnbs last fall on a elk hunting trip down to Grand Junction.
Nice.
Yeah.
Where'd you hunt at?
We hunted over in the Grand Mesa.
Yeah. Nice.
Yeah, a bunch of oak, scrub oak. It was brutal.
Yeah, it sucks. It's terrible over there.
I did have a shot at the biggest bull in my life, though.
We've got some monsters out here.
Yeah, but it was like 500 and I missed him twice.
I got a moose on the mesa last year.
No way.
Yeah.
Nice.
Yeah, big cow moose. That was crazy. They're way
Rifle or
bigger
bow?
than you think. Rifle.
Sweet.
Yeah, I didn't draw. I drew my archery bear tag this year and a deer tag for unit 40, which is a trophy unit. So hopefully that works out.
Good luck, man. I usually hunt in Gunnison in 54.
Yeah, we used to have a place down there by Pitkin. I don't know if you've hunted in that area, but
I'm familiar with it.
So yeah, there's some big animals over there too. My parents just sold their place in Telluride because then we've hunted there. There's some monsters in those canyons too, but it's miserable hunting. It's miserable carrying out, I guess. The hunting part's great.
Yeah.
Aaron, how long have you been in the business?
So coming back to it, 4 years, a little over 4 years.
Okay.
I've been in the business in the finance, and then I did banking and mortgage lending with a couple of different banks and some different things with trusts in the early 2000s. And then I left right before 08 came around, actually.
Good
You
move.
did, okay.
I was at one of the largest private banks in Illinois in 08, 09, and we were trying to get TARP money but at the time, because it was private, they didn't have a way to secure their investment. Like when they were giving out the TARP money to the public banks, they were basically taking treasury stock. And because of that, we couldn't raise capital because our founder had a $1.1 billion investment in Fannie and Freddie, which at the time was classified as tier 1 capital. So when they went up, we basically had a huge capital gap and we're undercapitalized, and then ended up getting acquired via receivership of the FDIC by the US bank. And I was part of a 4-person team managing $200 million of bank owned assets. And US Bank got our bank on a loss share deal at 80 cents on the dollar to 3.5 billion covered. So US Bank was only losing 20 cents on the dollar to 3.5 billion, and above 3.5 billion, it was a 95.5 loss share. So they were only losing 5 cents on every dollar. So we were just blowing shit out of the water. I was doing so many transactions, it was insane.
Yeah. When that happens, you can make some money for a
Oh,
minute.
the banks crushed it. I went
Yeah.
over to another bank, Wintrust, and then they were well capitalized because they were public and got TARP money. And we were just going out buying all these privately failed institutions. So I'd be on the due diligence side, and we'd look at like these $250 million to $1 billion banks. We'd just go through their whole commercial portfolio, scrub it. We'd have like keep assets and workout assets, and we'd just either work them out, renegotiate loans, restructure, or foreclose on them and blow them out. It was like the Wild West. It was so crazy in hindsight.
It was nuts. That's how my dad lost his hotel. They had a place in Elko, and the bank kept it as a keep asset and called his note due, which of course he couldn't pay it. And so then they just swiped a $11 million hotel and sold it for $3 million.
Yeah, it's crazy. And probably your dad was paying the note, but
yeah, he never missed a payment.
Yeah, and it was just a leverage issue because values went down, and it was like capital calls, right? Just
That's
like
exactly
if
what
you
it
had
was.
a buying stock on margin, you had a margin call, and people are like, I can't stroke a $5 million check to right side.
Yeah, that's where he was at.
Yep.
He's like, if I could have cut the check, I wouldn't owe you guys any money.
Yeah, exactly. Yeah, it was crazy. That's part of the reason that I ended up getting out of that business, is because those conversations were just brutal. You know, it's like you're dealing with good people in bad situations.
Although it was actually in Elko, and the bank of Zion picked it up, and then a 4-person group of elders from the Mormon church got all those keep assets for pennies on the dollar. It's weird how that worked out.
Yeah, it's like the Russian oligarchs.
Yeah, absolutely.
Yeah, it was crazy, man. It was and then ultimately, like, I went over to the production side and it was good, but I had like $40 million loan growth goals. My last loan package was almost $20 million. It was actually a private equity firm acquired a company in Provo, Utah. And that was like 9 months of full-time work, in addition to managing a $100 million portfolio on my own, in addition to running quarterly audits for the FDIC, the SEC, or the OCC. So it's just like the amount of hours I was working for the money I was making didn't
Terrible.
compute.
That's why I left banking too. It was funny. One of my clients at the trust department that I worked at was Tom Kartsotis, who's Fossil Watches. And same kind of thing. He's like, you'd never make money in banks. Why are you even there? And I was like, that's a good point.
Yeah. The best part about banking is the connections and the expense account, and just like the from my perspective, like just looking at the income statements and balance sheets of all these different businesses and meeting the business owners, that was more important to me than the actual job at the time.
That's how I got the job in car sales. When I left banking, was I managed one of the auto dealerships owners, a couple of his plans. He had a $20 million play money fund, which is nice. That would be cool.
I had a buddy who was a commercial banker down in he left Chicago, went to Mississippi, and one of his clients was buying commercial real estate, Planet Fitnesses, and it had like a $70 million enterprise value. And he became the CEO with 5% equity, with kickers up to 10% if he could increase EBITDA and get the enterprise value from 70 to 140 million. So if he gets it up to 140 million, he's going to be a 10% owner of $14 million. Crazy.
Good for him.
Yeah.
So I have a question for you guys as we're kind of talking about all this kind of stuff. I've been watching a lot of it, but just a bunch of different things, because obviously right now the hot button is the recession and all that kind of stuff. My question for you guys is, if being through all that one, because I started in the business in 2015. Honestly, I got into the workforce in 2008, 2009. So looking back at that one, based on looking at the numbers and looking at everything that way, I don't foresee that we're going to have the same kind of thing. I just don't see that.
So.
I think we will officially be in a recession, yes, but I know, like, local to my market, I don't see, I'm not going to get hit that hard. We've got so much going on here local to me that I don't see that. But my question is this, is what would you do? What would you, looking back on that one, how would you prepare for this one moving forward? You know, I've heard a lot of people say, pool as much cash as you possibly can, because you want to go and be ready for stuff that way when it hits. Or what do you see, pulling into stocks? Do you see it pulling into, I think, Jim, you were pulling up the S&P on that one, but what are you looking at? What do you guys see? What would be a good strategy for us and for viewers and everybody else that way? What would be a good strategy moving forward?
Yeah, I'm a huge proponent of cash positions. Like if I would have been sitting on like 50% of the cash I have right now, then like I was pretty early in my career, so I just didn't have a cash pool. But like when I talk about selling those assets at the bank, people were getting those compared to their market value that the assets were originally acquired at like up to like 60 to 70% discounts. So like imagine $1 million property that you can buy for 350, like, and all you need is cash because the loans aren't really there. Like the credit market's kind of dried up at that time. So if you could get some debt. Oftentimes on the commercial side, we were doing assumable debt. So like we would re-underwrite you. And if you had some cash to put in it and could right size the leverage, like we'd keep a smaller loan on the book and we'd take a write-off on the top end and we'd right size it with the equity. So cash was king, man. But I saw people with balance sheets that were worth $100 million on paper that were filing bankruptcy. It's like, because they were so levered. And when I say so levered, I don't mean like crazy leverage. I mean like 80% portfolio LTV. So they made on $100 million on paper, maybe they had 20 million in cash into this. It was probably lower at the time because it was off of their appreciation. So let's just say they appreciated 100% and they were $50 million into this total portfolio. At 20%, they had $1 million in, or $10 million, I'm sorry.
Yeah.
But that 10 million at 100 is 10%. And then they were underwater and they couldn't stroke checks to right size them. And we would just gobble up their portfolio and redistribute it to people with capital. Dude, it was crazy. So, but on a go forward basis, that's the first answer is I'm a huge proponent of cash and I'm a huge proponent of low leverage. I mean, even my personal residence, we're only like 50% levered, maybe even less with the appreciation currently. I just am like total debt averse because I've seen what I've done to people. Like as shitty as that sounds, like good people, it was just my job, man. It was my job to right size it for the bank and protect the bank. And we always used to say at the bank, he who holds the gold makes the rules, and the bank has the gold if they've got more money into the project than you. So they can pull the plug at any point in time. And the loan documents are written that way. They're written that, like, most people don't read all their loan documents. Frankly, I don't even read my loan documents because I know I either have to pay it or have enough cash for a margin call if I get upside down, which is not what I plan to do because I've got more equity in my property than most people, Secondarily, I would say from a business perspective, if you're talking transactional, what I do is make connections with commercial bankers, because if things go sideways and commercial bankers start to take back property, they're going to also be redistributing them. So they'll look to me to sell those properties. Then I have no interaction with the actual owner. I'll just interact with loan officers that are taken back. Like if it gets bad enough, there's going to be like divisions that handle this, but like most banks, like First Bank or whoever on the commercial side, typically any assets that go sideways are managed by the loan officer that wrote the loan. So if you make those connections and they're coming back, you could dispose of them as well.
I'm in the same boat. I owe generically probably the same on our house, 50% or less. Going through that, all the people that had cash, same thing, working in the banking in that time, we made wealthy people super rich. So they were able to come in and swipe up deals. My dad, another company that my dad was we did mine reclamation and things like that. So when they shut down a mine, we'd go in and reclaim it and do all that. But then HUD contacted him and wanted him to manage all the HUD homes that were going foreclosure. If you would buy homes in 10 packs, kind of is what they call it, you buy 10 homes in a group at once, they'd sell them to you for pennies on the dollar. You could come in and swoop up 10 homes for 10, 20 grand a home, kind of like you're seeing in Detroit and areas now. But you could do that then. And so all those people that had cash and could hold it for a little bit, they went from rich to stupid rich in not that long. And so, yeah, it's same thing. Going through that, we keep our debt minimum at, if you can't pay cash for it, we probably don't buy it as far as cars and toys and stuff like that. But then you're in a position when all that stuff comes around. I don't think Junction will get like that because we're always 12 months to 18 months behind everybody. And we're such a big draw from other states that are so much more expensive. I don't expect that here. But we'll always watch what you can see. So coming from the finance industry of cars and autos, I'm already seeing tons of boats and tons of campers on the market for way cheaper than what they bought them for a year and 2 years ago. So that's always the sign. Once they start slinging the toys, the rest of that stuff starts coming with it.
Yeah, for sure. Does that make sense,
good.
Kyle?
That's good because I'm in the market for a boat.
It's time right now. We sold ours 2 years ago for double what we bought it for. And I told my wife, I was like, we'll just put that money in the account and just chill and we'll just upgrade boats when somebody can't. So that's how I know those are all coming on the market, because I've been watching for 18 months and I'm finally starting to see stuff.
Right. Yeah, I mean, that answers a lot of my questions. I mean, I knew that answer, but it's also one of those things where it's like, well, you hear it enough kind of thing. Because that's a lot of what.
From your perspective, Kyle, like with the deals that you're doing, like you've got banking relationships. So if things go sideways, you're like, hey, if you need me to dispose of assets, I'm your guy, and you already have a good relationship. So you're going to be front of mind.
Right.
And start setting up your friends that have cash for those deals. Start talking to them about it now. I've got a buddy from Tampa that buys stuff up here all the time when it goes down, and he only visits Denver every once in a while, or Junction every once in a while, but he's got tons of cash. He keeps it mostly liquid or in bonds and stuff, so we can get it out of Chicago, a bond broker. I can get it in 5 days so we can close. And he's come back. He's flown up a couple of times. Like, where are we at? What are we doing? He bought here, which is crazy. 3 years ago, he bought 55 acres for $10,000 an acre, just in one of those deals. And he's always chomping at the bit. He's one of those guys. Same thing. His place in Tampa, he bought it for $300,000 like 6 years ago, and he's been getting 1.8 offers that he turned down. But
no kidding.
He's like Colorado, and it's set to go. So those guys with cash will come in and eat it up. So just shift your focus.
Well, and that's
Florida's
what
the
I've
state
gotten
for
a lot
wealthy
of
people.
that.
That's for sure.
Yeah.
And that's what I've gotten a lot of that. I've been kind of pooling together investors and stuff that way, just kind of people with cash. Like we've got an investment group that I work with and I'm a part of, that we have 300,000 in cash that we just rinse and repeat kind of thing. And we pull it back to 75 to 80% LTV, but keep it rented and keep it going that way. I mean, that's kind of the game plan anyway. So
sure.
But that's a lot of what we do. So yeah, I mean, that answers my question. That's what I was just kind of curious about.
Yeah. Jim or Ethan, you guys have any questions? What are your thoughts on kind of overall topic?
Not really too much, but I mean, kind of what you guys are saying, as far as the toys, I haven't really been paying much attention to toys, but yeah, first goes toys and stuff. But then I mean, even if let's say housing prices decline like 20%, well, shit, we're only 18 months ago. So yeah, big freaking deal. The way I look at it, because I'm actually really looking hard right now for place and stuff, and interest rates are higher and stuff, but not having to come up with any extra cash, for not having to sell any positions or anything like that, and be able to get into place. If it drops 10-20%, who cares if it's you know, your primary residence. And so like, if it goes back to like 2020 prices, a big freaking deal, interest rates drop, big freaking deal, just refinance. Like, so, and just like right now, well, in this market, I know we're a lot healthier than a lot of other markets are, I guess, a lot more
Right.
demand than what we have in a ton of other markets. So this wouldn't be necessarily across America, but for definitely here, just so much demand and so many people on the sidelines waiting. And there's too many people right now, I feel, that are like waiting to see what happens, where it's like, well, shit, you might as well just get in. Like, if you've been wanting to get in a place and now you can, without extra money down and maybe even getting some seller concessions and shit, then it just seems like, you know, go ahead. Well, your property values drop, maybe, but if shit drops or interest rates drop, then you got everyone freaking want to buy again, and you're going to be in the same damn situation. So better get refi at that time.
And it's funny because I get a lot of lenders telling me this right now, where it's this phrase. I don't know how many times I've heard it, and actually I've repeated it a couple
I
times.
know exactly what it is.
I'm sure it's
Marry and date.
marry the house, date the rate. I hear that so many freaking times right now. I'm like, get out of here. Like, okay, I get it, but still.
Well, my thing is, from investments is if you could time it, you wouldn't need me to give you a loan. So clearly you can't, and you missed the last 2 years, so you better get in at some point.
Yeah.
Right.
I mean, that's every investment. If you were good at it, you would already been in and been rich. Well, you're clearly not that great at it. So let's get in and get started.
Yeah.
And then let's figure it out from there. But everybody else also knows that the middle class, their wealth is in their home. That's just also a statistic that everybody knows, is that's where all their money is, or the majority of their money is typically.
Sure.
So you have to get started somewhere. I have people telling me that all the time. I'm like, well, that's what you've been saying for 2 years, and you missed 60, 80, $100,000, $200,000 growth on your home.
Yeah.
Get in it. You just get in where you can. If you're renting, you're throwing money away. And you're making, again, gets back to doing the right thing. You're making somebody else that's got money, more money. It's like everybody pulling out of their 401ks now because they went down. So they're always just going to buy high. That's the dumbest thing I've ever heard. It's like, if you don't put in now, you're not buying on the low side either. So your dollar cost average is always on the high side.
Yeah, it's got to be in the game.
Worst idea ever.
Be in the game.
Yeah.
You can't time the game. You got to be in the game.
That's the thing. If you could time it, you wouldn't need to talk to any of us because you just write checks.
Yeah. I give people the calculation, the renters anyway. And Ethan, this is a good one for you to run too, because Ethan, what's your average rent there? I think you're muted still.
I think he's getting it.
While he's figuring that out. But what I always pull him out, I always tell him like, hey, average rent, okay, let's just say you're paying, I don't know, $2,000 a month. I mean, you run your math, $2,000 times 12, you're in there for 3 years. There's 72 grand that you just freaking threw in the trash can.
With no tax deductions, with no equity growth.
Yep.
Nothing.
I'll be on the devil's advocate side on that. Like around here, so let's say you're paying $1,800 a month in rent. Well, then you have to go to $2,800 a month with HOA and everything else. You're paying like $400 or $500 in HOA. You're paying $1,000 a month in interest in the beginning and stuff. So really, you're going to look at 3 to 5 years before you even break even. And then plus you can have that down payment and cash and stuff to invest in the other assets, especially, especially if we're in a recession, to buy stuff. So it is a pretty big jump. And also in September, I think student loans are starting back up. So people are going to have another $1,000. So you're looking at like double expenses the next year. So like you can be looking at a couple $1,000s every month later in the year with buying, and you're not going to get a return. I mean, of course, in 10 years, that's going to be a great decision. But, and I think that's what a lot of people are having trouble with, because it's not necessarily, I know we like to say that, well, you're paying 100% interest on rent. Like, well, that's not true. You're not having a water heater go out. You're not having to replace your sewer lines. You don't have to replace all the water lines in your house. Like the shit that just can happen. Oh shit, like now you need a new roof and stuff like that. So you do have a lot more security and stuff with renting. And so you're guaranteed just $1,800 a month loss, whereas you could be, tens of thousands of dollars in just 1 year with owning.
Yeah, capital expenditures, sure.
So yeah, So in the long run, yes. And so it's very hard for people to see 10 years down the road. And so I think that's why a lot of people are having trouble like getting out of the hump, especially in that area. In Manhattan, I mean, shit, like you can buy a property, you can cash flow that, rent it out and cash flow it pretty damn quick. Here, I mean, you can't, it's very hard to make money because like this place, like for like $1,800 a month rents out for is $330,000. And that numbers just don't work. So it's like, well, why don't you just rent it and not have like all that other stuff and all that risk? You never know what's going to happen in life. You might have to move, you might get transferred, whatever, and have to sell this. And maybe in 6 months to a year, you could be maybe possibly taking a big loss. So
That's in
that's
anything too, though. I mean, there's risk in anything in that part of it. But see, the other part of that too is like, okay, so you have you've got $1,800 a month flat fee, you have nothing else. So buy something comparable. I don't know what's out there, obviously, but buy something comparable to that one. And even if you turn around and you straight up break even, make $0, well, then you just live there for free for the next 3 to 5 years. So if you let's say in that scenario you have $72,000. This is my mindset. Again, I'm in a small town, so there's a little bit of difference in that part of it. But it's also the same thing though, in the simple fact of if you break even and do $0 on it, when you go to sell it, you make no money. Well, then you live there for 3 to 5 years, or even 1 year. You live there for free. That you just saved yourself some money in the long run. Now, granted, you're not seeing that money in your pocket per se, but I don't know. I think there's differences to it all.
well,
Yeah.
that works for free.
To answer your question, we're at $1,400 a month.
1,400. And your average, you said first time home buyers 300, so you're going to be pretty close to that, having that same issue that I do too.
Yeah. Well, it's still going up here. We haven't topped out yet. It's going 400,000 median. Kyle, you're muted.
What's that?
Yeah, we're still going up here. I mean, median price, we're still going up.
Yeah.
Uh,
Guys, I see it's 12:05, so
Yeah.
I didn't know if you wanted to.
Yeah, no, let's call it and we'll reconvene on a new topic next week. Theron, thanks for stopping on, man. Really appreciate it. It was
Nice to meet you
super
guys.
insightful. And I'll look you up and I'll drop you a line with my contact info too. Let's stay in touch.
Yeah, for sure. I'll send you a couple of articles that just came out recently. One from Dave Ramsey and then one from Housing Wire, kind of going over that same thing with how many people are buying homes and it just doesn't look like it's going to go down. And then that stuff from Dave Stevens, I'll get Shalia to put that. It's a whole packet together. It's a bunch of slides.
Sweet.
With a lot of information. So it looks good for us. At least all of us in our markets for sure.
Yeah.
Yep.
Awesome. Thanks, guys.
Thank you.
Appreciate it.
We'll see ya.